Drew Blazsik Logos and Markets, the fourth and final video that we got here, which is going to be about the sensitivity analysis on our mortgage here. So we're going to look at what if we put extra payments down. We're going to compare it, the sensitivity. I'm going to introduce you to a ratio that I actually came up with in that regard. So let's get straight into our model. So we calculated what if we put extra payments in the assumption we hold to maturity. What if we do extra payments? How much money we make if we sell the house early? So we can, it's dynamic, automatically will calculate for us. And then last, we want to do what is our sensitivity analysis. So let's get straight into it now. And we're going to look at, we're going to do some calculations. And again, I have my own one I created. So let's look at this. So we're going to look at, we're going to use the data that we used before, but we're going to compare to interest rates. We could do a base rate. We could do a new rate. So we could just say, what if the interest rate is 6% and what if the new rate is 5%? So we just want to do our calculations here. So number one, we want to know is what is our percent change of our interest rate? And that's going to be, we're going to do this a bunch in the sensitivity analysis. That's going to be the new rate minus the old rate. This can be a negative. Now we're going to do absolute value with other ones, and then it's divided by the old. So we can see the interest decline by 16.67%. We want to compare what is the base payment and the new payment based off that interest rate. Let's make a normal loan. I think we have a normal one, 30 years, 12 payments. And we could just say this was the 6%. All right, so we want to know as well, what is our payments? We want to compare the two interest rates. So we're going to do a negative because we want that as a positive. So we'll say equals negative, and we'll do PMT. And then what we want to do is our periodic rate. Actually, we don't want the periodic rate. What we want to do, we want is this interest rate, the base rate, because we're going to compare the two. I want to divide it by the periodic payment. Next, we want to know what the MPER is. Where we enter 30 years. What is the loan amount? What's the future value, which is going to be 0. And then we can close that up. So here's the payment. Now we want to know the new payment. That's going to be the negative PMT. It's going to be that interest rate divided by monthly payments, MPER. So everything's the same, really, besides the interest rate. Loan amount, 0 future, and then close it up. Well, we can compare these two. What is the dollar change in it? So I just want to do the absolute value between those. Just want to know, well, what is the change of those $251? Next, what is the percent change in payments? So I want to know by how much did it decline? By 6 to 5%. So I'm going to go equals. We'll do the same thing. It'll be the newest one. Now this can be a negative minus the old. Divide by the old. Let's compare the total interest paid. What is the total interest paid? That's going to be our cumulative interest. And we want to do our rate, which is 6 divided by the PP. Periodic payment, NPER, everything's really the same. Loan amount. Start period, end period is NPER. And then we'll have to hit that 0 for the payment at the end. Again, I do a negative because I like to look at it as positive dollar values. Spit out as negative. So it equals negative again. And we'll do the cumulative interest payment. And that would be the rate divided by the periodic payment, comma, NPER. I'm going quick because I know you know how to do this. And then that would be NPER and then end of period. What's the change of dollar value from 6% to 5%? Again, I'm going to do the absolute value in this regard, and it's going to change by $90,000. Again, what assumption are we making? We hold it to the life of the mortgage. So you're paying 90,000 more by a 1% interest rate change. What's the change in interest? That's going to be the new interest. That's going to be a negative or positive, minus the old, divided by the old. All right, so we got a couple other values here. We can calculate the elasticity of interest. So we want to find elasticity value here, and we're going to always do an absolute value when we talk about elasticity. So that's going to be our percent change in payments. So elasticity is always a change of percentage change, and that's going to be divided by our percent change of interest rate. 0.63. And then we got something called the BMR. If you want to know what BMR stands for, well, that's the Blazsik Mortgage Ratio. What we want to know is, and we're going to do that calculation, not so important with interest rate change, but it is with this maturity rate change. So big talk was 30 years to 50-year mortgages. That's what we want to figure out. We want to know what is the change in total interest divided by the change in payment per month. So we're going to go equals. Well, what is the change of total interest divided by the change of our payments per month right here? So 360, all that's stating is that we're paying $360 for every dollar change of payment. So we're paying $360 total interest for a dollar change in payment. Now that doesn't really make a lot of sense with this. So maybe I should have deleted that, but it will down here. All right, so we did the sensitivity for our interest rate change. Let's do maturity. So what we're going to do here is, what if we go from a 30 to a 50, right? The president was talking about 50-year mortgages. If you know me, I hate 50-year mortgages. I believe it puts people into bondage, debt bondage. When you pass away and die, you're giving your kids debt. But what we're going to examine here, is it really worth it? Is paying 5 or 50 years worth it? And then that's where the BMR is going to come in effect, because what's the purpose of increasing from 30 to 50 is to decrease your payment per month, right? But we want to compare that to what is the total interest you're paying. All right, so let's do a few calculations. What is the percent change in maturity? We're going to do the new minus the old divided by the old. So oh no. Yeah, my Excel's slowing down. Let's look at the payment difference. We're looking at what is the payment difference of going from a 30 to a 50. So that's going to be our base payment will be, again, I'm going to do a negative, so equals negative. Can't type today. So that's going to be the PMT. We want to know what is our, now let me back up real quick. There's a bunch of assumptions we can make. And what we're going to do here, and I believe I did that, I'm going to make sure I did that in our model, is we have to make the assumption that if you are paying, let's say we're paying 6%, it's roughly, I think, 5.98 right now. We'll say 6% for a 30. We can make the assumption that a 50 is going to be higher interest. Because this a 50, now you can make that assumption, you can change it how you like, but we will do our table, and we have to make that assumptions, because the longer the maturity on a loan, the more risk you are to the bank. Therefore, they're going to charge you a higher interest rate. So if you compare that from a 30 to a 15 has a lower interest rate because you're less risky. So what we're going to do is we're going to make the assumption this is the 30 and then this is the 50. Let's find out what our payment is. So we'll do a equals negative. And that's going to be our payment. So we want to know, okay, this interest rate divided by PP. And if you want to change that assumption, you can make that the same interest rate if you like to. You don't have to say that they're going to have different interest rates. And then we want to know, now the MPER is going to be different, right, for each one, because this is going to be the 30-year multiplied times the PP. So they're going to have a different interest rate and different uh, MPER for that example. Now loan amount is the same, comma, future value is going to be 0, and then we can close it up. Now you're thinking, would it be a large change? Now with that interest rate hike, that's going to change things. So now we can say, okay, what is our new PMT? Well, that's going to be negative. That's going to be this rate divided by the production possibility, or I'm sorry, periodic payment. I'm thinking of economics right now. And now that's 50 years, right? 50-year maturity multiplied times payments per year. And then next is our loan amount, comma, next is our future value. And then we can close it up. Oh, wow. Look at that. Probably asking like, you're paying more per month. This is why the 50-year makes no sense. More per month if it's a 7% interest rate. Now we have to make some assumptions there. Let's just change it to, let's say 6.5. That's going to lower that payment. But the question is it worth it? I mean, it's going to be a higher interest rate, 100%. I mean, that's how loans work. But how much greater? So let's find some values here. How much of an interest rate change will it be? $143 you're saving per month by going 20 years more in debt. Let's find out the percentage change. It'd be the new minus the old, same thing we've done. Now, to find out, is it worth it? Let's look at the total interest paid based off that. All right, so total interest paid, we're going to go equals. We're going to do the cumulative. Let's do the negative. So we do the CUM. Again, we're going to hold the assumption we're going to pay it off. We're doing at the end of maturity. We're going to find out the total loan. Now we're going to build a table to say, what if you paid off sooner? We could examine different things there. So what we're going to do here is we're going to look at, well, the interest rate divided by the periodic payment, and then MPER, well, that's going to be this times periodic payment. Loan amount, 1, and then the ending period, which is going to be the 30 multiplied times the periodic payment. And then with this, you always got to hit comma and then hit the 0. Close it up. So a 30-year mortgage, you'll be paying over $463,000. That's more than the loan itself. However, what if you extend it to 50? So we'll see what that looks like. You know what? I'm going to pause the video. I want you to solve this. And I will do the, well, I want you to do it all. I want you to do the elasticity, which is the percent change in payments divided by the maturity in this example. And then I want you to do the BMR. So I'm going to pause it all, and I'm going to solve this right now. And I'll be back in a second. Welcome back. Let's look at these values. I think this is insane. So what are you getting by increasing at 20 years? Well, the purpose of it is to put more people in an affordable way for payments. But like I mentioned before, if this is 7%, that makes no sense. We are, I think that's absolute value wise. Or maybe I didn't do absolute value with that one, but you're paying more for that new payment. So it makes absolutely no sense. So let's go to 6.5 that we had the interest rate at. I'm going to show you what this works. So you're paying $489,000 more in interest. That is a percent in interest. You're paying 105.66% more interest for a decline of nearly 6% less in payments per month. So you say, okay, I'm going to save $143 per month, but I'm going to pay another house, right? A $400,000 loan, you're going to pay $952,000 in interest. That's $489,000 more. And it'd make it even crazier. What if this was a 15-year mortgage? Look, you're only going to pay two. That's how much interest you will be paying extra by increasing it to 50 years. So let's go back to the 30. Um, the change in maturity, right? It increased by 66%. Our elasticity is 0.09, very low. And then our BMR, what does that mean? For every $1 reduction in a monthly payment, you're paying $3,416. So in other words, you want that extra dollar reduction per month. That's what it's costing you. For every dollar you're saving per month, I don't mean saving, paying less per month. It's costing you for the life of the loan $3,460. More than likely, that's what it's costing your kids when you actually, you pass away and you give your property to your kids because you're probably going to owe money and you've been paying that. You could have been adding all that money. That's extra. That's what you're paying extra on top of the loan for every $1. I think that's insane. So, all right, no more my morality of loans. I think this is very unethical to do so. All right, let's go over here. We're going to look at, and all you're doing is bringing those in. We don't have to do that right now. All right. We're going to compare a bunch of stuff here. We can compare, well, we did the 15. Oh, we got to do the 15 and the 30. So we're going to look that up in a second. So let's build our table. And we're going to show you, Zach, what the graph looks like and how do payments change. So we're going to look at, let's start this off by 5. And then we're going to say the previous plus 5. So we're going to build our table by every 5 years. So let's drag that down and hit Control D. Next, what we want to do is we want to know, well, what is our payment based off our interest rate of 6% and 6.5? So we're going to go equals, we're going to do negative, and we want to show what it looks like at different maturities. So in other words, when we increase it to a certain point, we can see when in the 1930s, they had 10-year mortgages. Well, they started in the 1930s a 30-year mortgage. And you can see it actually does have a pretty big decline in payments from 15 or 10 to 30. But when you go from 30 to 50, we're going to see it level off. Is it worth it? Okay, so we want to know, what is the interest rate? Well, that's going to be the interest rate up here divided by PP there. And then we want to know, well, total number of payments. That's going to be our maturity here multiplied times PP. And then we're going to look at, well, what is present value? That loan amount does not change. Future value is going to be 0. And it's going to be at the end of the period. And then we can close it up. I believe everything looks good. So, no, it does not look good. What did I forget to do? I forgot to put a dollar signs on the interest rate. So I hit function F4. And then it's going to be so it shows with the 6% interest rate that as you increase the maturity, you see it dramatically fall. You see it dramatically fall in payments as maturity increases at a 6% interest rate. I'm not sure what did the whole thing there. I think this is my Excel sheet not working right, but let's look at the 6.5%. We can see the same here. I'm going to go equals. We'll do negative PMT. We got the interest rate. We'll go to that other interest rate up here. And then divide by periodic payment. Hit comma, MPER. Well, that's going to be that maturity here. I want to drag that down. I'm going to multiply it times periodic payment. All right, next we want to know the present value of this loan amount. Next we want to know is our future value. I should probably just have you calculate it without you watching, because what did I forget to do? I forgot to put on that C8. Let's freeze that interest rate so we can see both interest rates, so we can compare it and see what our payments look like. Let's go over to our graph. There we go. And what I really want to show here, look what goes on. When you increase maturity past a certain point, payments don't change much. At the beginning, it does. From a 5 to a 15 to a 30, it does have a dramatic change, but it levels off around 30 to 40. Why? Because of compound interest. If you increase it to a certain point, you're paying so much interest. And we'll show what that looks like in a bit. All right, so now what we want to do is we're going to show our PMT curve. Our PMT curve here. And why is that important? Is let's pull up. I'm going to look up right now 15-year mortgage rate, Fred. And I'll pull it up so you can see it in a second. So, and then we got a 30-year, and this is important to do these calculations correct. 30-year Fred mortgage. All right, I'm going to pull this in and show you what I'm looking at. What we want to do is we want to find out what's the 30-year. 30-year is 6%. What is the 15? There's no such thing as a 50, so I can't look up the 50. Is 5.43. So changed a bit, 5.43, and then I'm going to hit tab, and then we want to do a 6. Okay, so what we're trying to figure out here is if we know the difference between a 30 and a 15, right? So what we're doing here is I want to find out that difference. So equals, and this is just a logical assumption I have to make. What is a 50-year mortgage should be? So it's 0.57% difference from a 15 to a 30. Next we want to know is, since we're going by fives, I want to know what is our the interest rate change, right? It changes by 0.57%, and I'm going to divide it by 3 because that is 15 years difference. I'm going to divide it by 3, which will give me the average change per 5 years. Okay, since we got that, what we can do now is we can plug in, well, what is the 30-year? So this is going to be our PMT curve. So this is the most accurate curve. We'll try to show you what an interest rate curve will look like based on if you went from a 5-year to a 90-year mortgage, for example. So if I plug in that's what a 30-year is. Oh, let me make sure I did a... I did a 35. So we want to do there. There we go. That's our 30. And then we could plug in our 15. I'm going to say equals. There's our 15 right there. So now what we can do is we can make a logical assumption that's going to be increasing by 0.19% every 5 years. It's not perfect, but it made sense to me. I think this is a simple way of looking at it. Let's freeze that. So we can make our assumption that if we went from a 30 to a 35, that's what it'll look like. Now I could drag this all the way down, Control D. So we could say if it was a 90-year mortgage, and we're just doing this for visualization purposes, that it might be a 8.28% interest rate. So it's going to change the whole equation. So when we go back to this curve, you see how it's sloping down? Well, interest rates should go up if you're going to hold on to 90 years. It might slope up. It's going to look a bit different. To figure out in between, I'm going to go to the previous minus this 0.19, right? And then I can do the same here. The previous minus that. And then we can say, well, what is this minus here? I'm just going to freeze it, make it a lot quicker. And then you can just drag that up. So now we got interest rates based on what a 5 may look like, a 10, a 15, a 30. Now the 15 and 30 are accurate, and we just made logical assumptions here. Next, what I want you to do is I want you to plug in our PMT curve based off this interest rate, based off that maturity. I'm going to pause it here. I want you to do it on your own, and I'll see you in a second. Okay, so I just completed it, and here's all the different payments, our PMT curve, and that's based off a different interest rate. We're not going to use the same because that wouldn't make sense. Different interest rate and a different maturity for each one. So you can see that it goes from payments, it's downward sloping, right? It's going lower, 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 and then it gets, look at that, 332, 308, and now it goes up 311, and then it skyrockets. So let's look at. Oh, I don't have the curve listed here, I don't think. Hold on. I'll include it in your model. I don't have it listed. One nice thing about Excel, you can hit that filter button. You could take a curve off if you wanted to. But I definitely want to show you that the curve really is upward sloping. It's going to be sloping down, and then it goes straight up. Okay, so we're almost, what are we in? 26 minutes. It's going a little longer than I thought. Now let's compare our curve. We're going to look at total interest. Again, I'm going to try to have this corrected, this graph. I don't want to redo it, but I'm going to add in this so you can see what a PMT curve will look like with estimated interest rates rather than, because this makes no sense, the same interest rate with all those maturities, right? You can compare the two. That's what you could do, but we should have different interest rates based on that. Next, we're going to look at our maturity. So we're going to compare. We're going to compare the total interest. So we're going to do, and then we're going to have a graph that shows, and I think will be complete. We'll have everything completed. So let's look at maturity. We're going to go equals. We're going to start it off with 5 years. We're going to go by 5. So I'm going to go equals the previous plus 5. All the way down to the shaded area. Next, we want to know there's 2 different interest rates, right? That's what we're comparing. I should have done that before, and I probably do that in my new model, is I should have a yield based off those different interest rates and look at the total interest paid. We're only going to compare off maturities based off those 2 interest rates we have above, but I should have a separate one too. So we want to know what is the total interest paid based off that interest rate. So you know how to do it. Is you're going to do the cumulative interest payment. I'm going to pause the video. I'm going to get those completed. We're going to show the 2 different interest rates we have above. I want to pick those 2 and based off those maturities. And then we could compare the results. All right, I'm going to pause the video and I will see you in a second. Okay, I got the first 2 solved, so I'm going to highlight those. I'm going to drag it all the way down. And if we did it correct, it should fill up. There we go. It did fill up there. So I think I misquoted my actual model. And what I said was, I wish I included a interest rate based off these interest rates. I forgot I did. I don't give myself enough credit, I don't think. But so what we're going to do is, and we can do that together in this video, or this part of the video, is I want to find out the total interest paid based off of these interest rates with that maturity. So I'm going to go equals. So we're going to look at total interest paid, the interest curve. So I'm going to go equals. When negative, make it positive. The cumulative interest, we should know how to do this. The first thing we want to know, what is the interest rate? Well, that's going to be this interest rate here. That's going to be divided by PP. Next is we want to know Number of payments, well, that depends on maturity times PP. Next is loan amount. Next is start. Next is end of period, which is at maturity, multiplied times periodic payment. And then we want to hit a 0. All right, so I'm going to drag a couple down and make sure it works. Yeah, so this is going to be more accurate with interest because you're going to pay lower interest rates for that interest below 15, and you see how it's much more interest if we have a higher interest rate. All right, there's our curves there. I don't have that interest curve. I'm trying to put it on yours when you're looking at it. But it shows the total interest paid for 6% depending on maturity. See how it skyrockets, total interest paid on 6.5%. And then we have our interest curve up to 2.5 million, which would definitely be off, 2.5 million be off the charts in this example. Oh, you know what? This only goes up to 50 years. Oh, that's fine. Only goes up to this part right here. That's why it only goes up to 950,000. This would skyrocket after that part. But just to let you know, I wrote an article for a publication, and I didn't want to do 90 years. I want to show up to 50 to show that. But it definitely shows the interest. If you're going to do that, here's the 30. There's the interest paid. Here's the 50. You're doubling your interest by just getting a few $100 off extra month. So there you go. I think that's it. That's it for the video. If you look at your grade, you just got to fill in these portions here, and your grade should be 100% after that's filled up. But there you go. And hopefully you get a good understanding of how mortgages work. Hey, if you have any suggestions of what I should do to add to be more in-depth, other ratios that you could think of, send me a message and I may teach this in a video, and I'll use your name for the actual ratio if it's worth it. I came up with the BMR. It just shows you the amount, again, the amount of dollars you're paying extra on the interest, total interest you're paying. It's going to cost you for every $1 reduction on payments. Is it worth it? In this example, $34.16. You're paying that for just $1 each month. So there you go. Any questions, please let me know and send me if you have any suggestions on it. God bless.